student loan debt in the United States has reached historic levels. More than 45 million borrowers now owe over $1.7 trillion. For many people, monthly payments feel overwhelming, stressful, and never-ending. But here's something most borrowers don't realize. There is a financial strategy that could lower your interest rate, reduce your monthly payments, and even help you pay off debt faster. It's called refinancing. And in this guide you'll learn exactly how it works, who should consider it, when to avoid it, and which lenders are considered the best in 2026. Refinancing can be a powerful tool, but it is not right for everyone. Choosing the wrong refinance option could actually cost you money or cause you to lose important federal protections. That's why understanding how refinancing works before applying is absolutely essential. By the end of this video you'll know what student loan refinancing is, who should and shouldn't refinance, the key factors to compare lenders, the top refinance lenders in 2026, and a step-by-step strategy to choose the best option for your financial situation. Let's start with the basics. What is student loan refinancing? Student loan refinancing is the process of taking out a new loan from a private lender and using that loan to pay off your existing student loans. In simple terms, your old loans are replaced with one new loan. This new loan may offer a lower interest rate, a different repayment term, a lower monthly payment, or a faster payoff timeline. For example, instead of juggling multiple loans with different due dates and interest rates, refinancing combines everything into one single payment. Sounds great, right? Well, there's an important catch. If you refinance federal student loans into a private loan, you permanently lose federal protections. These can include income-driven repayment plans, hardship deferment, and loan forgiveness programs like public service loan forgiveness. So refinancing can save money, but only if it fits your situation. Who should consider refinancing? Refinancing tends to benefit borrowers who meet certain criteria. You may be a strong candidate if you have good or excellent credit. You can qualify for a lower interest rate. You have high-interest private loans. You have stable income. And you want to simplify multiple payments into one. On the other hand, refinancing may not be the best choice if you rely on federal protections. You expect financial hardship. You're pursuing loan forgiveness. Or you benefit from federal repayment programs. Here's a real-world example. Imagine Sarah. She has federal loans and struggles with monthly payments. She works for a nonprofit organization that qualifies for public service loan forgiveness. After 120 qualifying payments, her remaining balance could be canceled. If she refinances into a private loan, she loses that eligibility instantly. For Sarah, refinancing right now would be a costly mistake. Refinancing versus consolidation, key difference. Many borrowers confuse refinancing with consolidation. They sound similar, but they're actually very different. Refinancing is done through private lenders. It can lower your interest rate and save money, but it replaces your loans with a private loan and removes federal benefits. Federal consolidation, on the other hand, is done through the government. It combines federal loans into one payment, but it does not lower your interest rate. Instead, it averages your current rates. The key difference is simple. Refinancing focuses on saving money. Consolidation focuses on simplifying payments. Understanding this distinction is crucial before making a decision. Factors to evaluate before choosing a lender. Not all refinance lenders are the same. Comparing them carefully can save thousands of dollars over time. First, interest rates. You'll usually see two types: fixed and variable. Fixed rates stay the same for the entire loan term. Variable rates may start lower but can increase later. A lower rate generally means less total interest paid. Second, loan terms. Most lenders offer terms like 5, 7, 10, or 15 years. Shorter terms mean higher monthly payments but less total interest. Longer terms mean smaller monthly payments but more interest overall. Third, fees. Some lenders charge origination fees or penalties, others don't charge anything at all. Always read the fine print. Fourth, cosigner options. If your credit isn't strong enough, a cosigner can help you qualify for better rates. Some lenders even allow cosigner release after a certain number of on-time payments. Fifth, customer experience. A lender with strong support, helpful tools, and clear communication can make a big difference over the life of your loan. And sixth, incentives. Some lenders offer rate discounts for enrolling in autopay. Even a small discount can save hundreds of dollars. Best student loan refinance lenders in 2026. Let's look at some of the top refinance lenders currently considered competitive in 2026. First is SoFi. SoFi is often rated as one of the best overall refinance lenders. It offers both fixed and variable rates, flexible terms from 5 to 20 years, and no origination or prepayment fees. It also provides unemployment protection and career support services. It's best for borrowers with strong credit who want competitive rates and extra benefits. Second is Earnest. Earnest stands out because of customization. Instead of choosing only preset terms, borrowers can tailor repayment length more precisely. It also offers rate discounts for autopay and detailed financial tools. It's ideal for people who want flexibility and control. Third is Common Bond. Common Bond combines refinancing with a social mission. For every loan issued, part of the proceeds help fund education for children in need. It also offers cosigner release and strong customer support. It's a good choice for borrowers who value social impact alongside financial benefits. Fourth is LendKey. LendKey partners with credit unions and community banks. This means borrowers may access competitive local rates and personalized support. It works well for people who prefer working with community-focused institutions rather than large corporations. Fifth is PenFed Credit Union. PenFed is especially known for strong rates and benefits for military members and their families. It offers fixed and variable loans and is open to many membership groups. It's particularly attractive for borrowers connected to military communities. And sixth is Laurel Road. Laurel Road is often favored by high-income professionals, including doctors and specialists. It provides competitive rates for borrowers with strong income and credit profiles. It's best suited for professionals seeking premium rate options. How to choose the right refinance option. Choosing the right refinance loan isn't about picking the most popular lender, it's about choosing the best fit for your finances. Start by understanding your debt. Know whether your loans are federal or private. Know your total balance, interest rates, and monthly payments. Next, check your credit score. Borrowers with higher scores usually qualify for lower rates. If your score is below around 680, you might improve your chances by waiting, improving credit, or applying with a cosigner. Then compare lenders. Use comparison platforms to view multiple offers at once. Always compare APR, not just interest rate, because APR includes fees. After that, consider your job stability. If your income is unpredictable, a longer term might make payments more manageable. And finally, think about your future plans. If you may qualify for forgiveness or federal protections, refinancing might not be the best move yet. Should you refinance federal loans? Refinancing federal loans can be tempting, especially when private lenders advertise lower rates. But remember, once you refinance federal loans, you permanently lose federal benefits. You might consider refinancing federal loans if you don't need federal protections. You qualify for a much lower rate. You have stable income. You should avoid refinancing federal loans if you plan to pursue forgiveness. You expect financial difficulty. Or you rely on federal repayment options. Pros and cons of refinancing. Let's quickly summarize the advantages and disadvantages. Pros include potentially lower interest rates, lower total repayment cost, simplified payments, flexible loan options, and faster payoff potential. Cons include loss of federal protections, qualification requirements, and possibly paying more overall if you extend your term. Real savings examples. Even small rate reductions can lead to major savings. Someone with $50,000 in loans dropping from 7% to 5% could save over $5,000 across 10 years. Another borrower refinancing $100,000 from 10% to 7% might save over $25,000 over 15 years. That's the power of interest. Final conclusion. Student loan refinancing can be a smart financial move, but only when used strategically. The best candidates are borrowers with strong credit, stable income, and high interest rates who don't need federal protections. Before refinancing, always understand your loans. Compare multiple lenders. Review all terms carefully. And make sure the savings are worth it. With the right decision, refinancing can turn overwhelming debt into a manageable path toward financial freedom. If this guide helped you understand student loan refinancing, subscribe for more clear and practical financial insights. And if you're considering refinancing, take time to compare your options carefully, because the right choice could save you thousands. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Interest rates, lender terms, and eligibility requirements may change. Always consult a qualified financial professional before making financial decisions.